Okay, so this is a very brief video. I'm just going to quickly talk about things called non-deliverable forwards. So in a few of my previous videos, I talked about forwards and futures, and in these videos I was talking about deliverable contracts, deliverable forwards or deliverable futures. So these are contracts which oblige market participants to either buy or sell a currency at a certain time in the future for a certain predefined price. So you can use the example of a euro-dollar future, and you can say you can buy 1 million euros of a euro-dollar future with a settlement rate of 1.3, and let's say it's 1 month in the future. So when it comes to 1 month's time on the settlement day, you're obliged to buy 1 million euros at an exchange rate of 1.3. So once you have these euros, you can then immediately sell them back into the market and either make a profit or loss depending where the exchange rate is. So if euro-dollar's gone up, you can sell the euros for a higher rate and get more dollars back and therefore make a profit. But if euro-dollar's gone down, you can sell the 1 million euros, but you won't get as many dollars back, so you make a loss. However, there's some of these forwards which trade, and they're referred to as being non-deliverable. So what that means is when it comes to the settlement date, cash is not actually exchanged. So you have a forward or future position, but when it comes to the settlement date, you don't actually carry out the trade. And these are sometimes called NDF for short, non-deliverable forwards. So what does it actually mean if you're not exchanging the cash? So what actually happens is profit is calculated based on where the exchange rate is at the time of expiry, based on the previous graph. So it's as if you had a real deliverable forward, but you don't actually exchange the cash. You just get the profit you'd have made from having that position. So an obvious question in that case is, how is this exchange rate determined? Who determines the exchange rate you use to calculate the profit and loss? I'll put here a chart from Bloomberg of dollar ruble, and although this is a long-term chart, you couldn't just look at the chart and say, where do you think euro dollar is at exactly the time of expiry and settlement for the contract, because there'd always be arguments and people would argue that maybe the data on Bloomberg isn't necessarily correct or whatever. So the way it's done is actually you have organisations which are independent, and they will poll several banks and they'll ask, where is, for example, dollar ruble trading right now? And they'll generally ask, half an hour, 20 minutes before the actual fix. Then soon after the fixed time, the average is calculated and it's published. And these are actually published online, and anyone can have access to these numbers to see where dollar ruble settled, for example, today. So that's what's used, and all of the standard traded contracts trade against these standard published rates. So you sometimes do get sort of odd contracts where you use a non-standard fix for certain reasons. There may be a regulatory reason or credit reason, but these are very, very uncommon. You'll also find that if you're an individual trader and you trade through a spread betting company, for example, that the cash is never delivered. Of course, you don't expect to trade euro-dollar and then end up with 1 million euros in your account. Basically, you'll buy a contract, and when either the contract expires or you get it closed out, you'll basically have the profit or loss calculated and deposited in your account. So this is another type of non-deliverable forward, for example. So there's actually conventions in the market of which currencies trade as non-deliverable forwards and which ones trade as cash settled contracts. So things that are highly liquid and generally like G10 or G20 currencies, such as euro dollar, sterling dollar, and all these sort of things, if you trade a forward or future, you expect to take delivery of the cash unless you close the position out. It tends to be some of the emerging market currencies which have non-deliverable forwards as their convention. So the reason for this is sometimes regulatory. So China, for example, is a good example where there are restrictions on taking cash into and out of the country. So it makes it hard for market participants to actually trade the Chinese yuan. But people still want to, so what they do, they trade non-deliverable forwards. So they'll trade these contracts against each other without actually touching any of the Chinese currency. And then when it comes to the fixed date or the fixed time, they'll just use the rate that's published. So a few others, ruble, the Indian rupee, Brazilian real, and a few other ones like that, generally will by convention trade against a fix, meaning they're non-deliverable. That's not to say that you can't trade some of these currencies as cash. You can, but the market's a lot smaller because it's a lot more restricted. So if you're in a bank and you do really need some rubles in your account, you can do that. but the market's not as liquid. So if you're a big player and you want to take big positions, generally these things will always trade as non-deliverable forwards.